Hello, and welcome to the September 2022 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. After a strong rebound in July, markets pulled back again in August. U.S. and developed international markets started the month strongly, but then pulled back and ended up down by 3 to 5%, with only emerging markets showing a small gain. Fixed income was also down, and it was another weak month for financial markets in general. Once again, the primary driver was interest rates, which rose sharply after Federal Reserve Chair Jerome Powell indicated rate increases would continue until inflation subsided, even if the economy slowed. Markets reacted by taking the 10-year Treasury yield from 2.6% at the start of the month to 3.15% at the end, a substantial increase. Higher rates provide for lower stock market values, and with fears of a recession taking down expected earnings levels, the market had a double whammy last month. But despite the market pullback, the good news was that last month's data showed the economy is still doing pretty well. Job growth was a particular bright spot, coming in well above expectations. Inflation was also positive, as both consumer and producer inflation showed signs of peaking. Both major measures of consumer confidence also improved, and overall, despite the fears and headlines, a recession doesn't look likely in the near future. But while that's good for the economy, perhaps surprisingly, it also keeps the risk for markets higher, as a stronger economy means the Fed is more likely to keep raising interest rates. And that conflict between rates and growth is the primary hurdle for markets now. Looking forward, it also sets the stage for the rest of the year. But despite everything, that might be better than it now appears. Well, why is that? First, the Fed has clearly laid out its plans, and markets are now expecting higher rates. But the higher the expectations, the greater the chance rates will end up lower, which would be positive. Second, markets now expect lower growth or even a recession, which makes positive surprises more likely. So with expectations depressed, we don't actually need good news for markets to rally, just less bad news. And that looks increasingly possible. Now, that's not to say we're done with turbulence. Markets are still struggling to interpret everything that's happening, and the potential for more bad news is very real. But despite the headlines, many of the risks seem to be priced into the market already, and the scope for positive surprises is very real. And that's the bottom line. We're certainly going to see more economic and market turbulence in coming months, but much of the potential bad news, including higher rates and a recession, seem to be largely priced in. The downside risks are real, but the upside opportunities are also very much present. That's it for this update. Thanks for watching. Join me in October for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.